Towards the end of 2023, the Bank of Zambia announced a new issuance method for Zambian government bonds. Effective January 2024, the Zambian government bonds will be issued at par value or face value instead of at a discount. This is in the primary market. What does this mean with regards to our current investments in Zambian government bonds? And how does this affect our return on investment going forward? This is what I would like us to look at on today's episode. If you are a subscriber already, a million thank yous to you for subscribing to my channel. If you haven't subscribed, consider subscribing to my channel by clicking the subscribe button. It is at the bottom, it is down here. Click subscribe right now. Let's get started. So I would like us to read this announcement together and see how it affects our investments this month, January. It says, the Bank of Zambia wishes to inform the general public and investors in government securities that effective from January 2024, the government of the Republic of Zambia bonds, GRZ bonds, will be issued at par in the primary market for all new issuances. This means that government bonds will be sold at their face value, that is, the cash amount to be invested will be the same as the face value amount. Issuance at par entails that the coupon rate for each instrument will be determined during the auction. We therefore wish to advise that the coupon rate for each instrument on auction will be the respective highest accepted yield rate. Reissuance of any existing bonds and secondary trading of any bonds may be done at discount, par, or premium depending on market conditions. The change has been made to streamline government debt metrics and debt service in general. The general public and all investors are advised accordingly. So this is the new announcement. Now, a lot of us have been really concerned about this new development. And so I would like us to look at this in detail and see how it's going to affect our investments. In order for you to understand the significance of this new issuance method, you need to understand that we've got two markets in terms of government bonds. The first market we have is the primary market. The primary market is where you buy the government bonds directly from the issuer. The issuer is the government that is borrowing money from you. In this case, the government of Zambia through the Bank of Zambia is borrowing directly from the investors in the primary market. When government bonds are issued in the primary market, they are normally conducted through an auction. During the auction, investors will offer a desired interest rate that they want to make from their investment. And it goes through an auction. The Bank of Zambia will choose a cutoff price that is desirable for them, that is cheaper for them. And in this case, it's a cutoff price that is a bit higher. And so they will choose a cutoff bid price. If you look at the previous bond results, let's say for December 2023, you will normally find on the bond auction results, you will find the cutoff bid price. This is the price that has been selected during an auction on which all investors are going to base their calculations of the cost value of their bond investments. So for example, if you are intending to invest in a 10-year government bonds, as per the results of December 2023, the cutoff price for a 10-year bond was 56.5202. So this had gone through an auction. And if you check, there was actually a range of successful yield rates and a range of unsuccessful yield rates. So these yield rates result in this, determine what kind of cutoff price is going to win the auction. And so this is what used to happen previously. Now, with this new change in the issuance method, we are told that the coupon rate is what will be auctioned going forward. And the highest accepted yield rate is the one that will determine the coupon rate. So rather than bidding the cutoff price, from January 2024 going forward, what will be bid is the coupon rate, and the highest yield rate that an investor has auctioned for is the one that will determine the coupon rate that we are all going to be using to calculate our coupon incomes. So this is the significance of this change. Now, what happens? How do we translate all this? So I've explained what the primary market is. The primary market is where you buy your investments directly from the issuer, yourself as an investor. Then we have the secondary market. The secondary market is where you can buy and sell investments in the government bonds at whatever price you want to sell, but depending also on the economic performance of the country, because that affects the value of the bond, particularly interest rates. Interest rates affect the value of the bond very much when it comes to, how much you can sell or buy a bond at on the secondary market. One other important thing to understand is that government bonds are issued basically at three prices. You can have a government bond that is issued at a discount as it was previously. This simply means that you buy the government bond at a price lower than the face value. In Zambia, the face value amount normally starts at 100 kwacha. So one bond is equivalent to 100 kwacha. That is the face value. So if you are buying a government bond at a price which is less than 100 kwacha, in this case for the 10-year bond, if you go back to the 10-year bond, if you are buying this government bond at a cost of 56.52, it means that you are buying it at a discount. Assuming that you bought this bond at 100 kwacha, that means that you are buying it at par value. Let's assume you buy this bond at 110 kwacha. That means that you are buying this bond at a premium. So these are the three kinds of pricing methods that we have for government bonds. You can buy a bond at a discount, you can buy the bond at a par value, or you can buy the bond at a premium. Now, with regards to the Zambian government bonds, instead of them selling these government bonds at a discount, they will now be selling them at par value, which means that 100 kwacha is what they'll be expecting instead of at a lesser amount than 100 kwacha as it were previously. So I would like us to look at a few computations with regards to how the new change is going to affect our investments in the government bonds, both in the primary market as well as the secondary market. So I've done some calculations here based on a 10-year government bond. This is the old method. If you look at this, I'm highlighting the old method and let's color it, and this is the new method. So currently, if you look at a 10-year government bond, if you compare with the previous month's results, December 2023, you'll find that the coupon rate for the 10-year government bond was 13%. And then the semi-annual, meaning that because government bonds are offered biannually, meaning that you get the coupon rate twice in a year. So if you have 13% as the annual coupon rate, the biannual coupon rate is 7%. So you simply divide that by the 13 by 2, it's 6.5%, rounded off to 7%. So that's the semi-annual coupon rate. Have made an assumption here that you are buying a 10-year government bond for 4 million kwacha face value, and the number of years is 10. Because you are going to receive the coupon income twice every year, we multiply this 10 by 2 to give you 20 payments. So you receive 20 coupon incomes. Now, to calculate the coupon payment, you simply get the coupon rate multiplied by the face value. When you do that, for this 4 million, you get 520,000 per annum. We need to divide this by 2 in order for us to know how much you'll be getting semi-annually or biannually. Every 6 months, you'll be getting about 260. This is before withholding tax and the handling fee. So I'm not including the withholding tax and handling fee, just to make it really simple and straightforward. So in this case, you're going to get every 6 months, you'll be getting 260,000. Now, I have done some calculations here to arrive at what we call the present values. So when we are looking at government bonds, it's very important that you understand that government bonds are comprised of basically two components. We have what is referred to as the coupon income, which is fixed throughout the tenure of the bond. Now, this coupon income, because it's fixed, it's a fixed amount throughout the tenure of this government bond, we call it an annuity. An annuity is simply a payment that you are going to get across a period of time, which is a fixed amount. So we need to know what the present value of the annuity or the coupon incomes is for this 10-year period. So this is what I've put in this column, which is B12. The other component of the government bond is the face value. So you need to understand that at the end, when you've invested in a government bond, for example, this 10-year government bond, at the end of the 10-year period, as long as the government does not recall this bond, because callable, some government bonds are callable, meaning that the government of Zambia can decide to say, we are calling back this bond, we are going to pay you, or we are going to pay you back whatever outstanding coupon incomes are due to you up to this point, and we'll give you back your face value amount. I've explained this in previous videos. I can do another video if you want to. Give me a comment in the comment section below if you want to know more about these callable bonds. You need to know that we've got 3 callable bonds. We've got the 7-year, the 10-year, and 15-year government bonds. As long as they've served 60% of their life, the government of Zambia can call them back and pay you off. And this is for specific reasons that I can discuss in a further detail in another video. So right now, I want us to focus on the 2 components of government bonds. I've already discussed the annuity, which is the coupon income that you get throughout the life of this bond. So if for a 10-year government bond, you will get 20 coupon incomes. The other component is the face value amount, which is the 4 million Zambian kwachas from our example that we are looking at. And so we need to understand, because government bonds are future incomes that you are getting. You are going to be getting coupon incomes all the way up to 10 years. And this face value amount, you only get it in the 10th year. So you need to understand the present value. What is the value of 4 million today? Because this 4 million, you are going to get it in 10 years' time. If you know the time value of money, you know that 100 kwacha today is worth more than 100 kwacha 10 years from now. Now, if you understand that, definitely you need to understand the value of your 4 million today, because that 4 million, you're only going to get it 10 years from now. So what is the present value of your 4 million kwacha today? So these 2 components help us to determine the value of your bond, or your cost value of this government bond. So under the current method, if you look at even the cutoff bid price, you're going to find that the value of the 10-year bond, the December 10-year bond, was about 2,262,000 kwacha. In fact, it was about 2,260,000 kwachas. So I've used some computations here. And formulas to get the present value of the coupon incomes. You simply put in this formula, which is PV, and it's going to give you this result. So it's present value. Don't forget to put the negative in front, because if you don't, to turn the negative into a positive, so include the negative in front of the formula. So it's the present value of the B10, which is the coupon, the market rate, okay? The market rate, I'm going to explain what that is, as well as, so it's the present value of the number of payments, okay? Number of payments slash the coupon payment, that is the coupon income, the biannual, and then the biannual coupon rate, the market rate. All right, this will give us the present value of all the coupon incomes that you're going to get. What about the present value of the face value amount? So again, if you put in this formula, which is up here, B4 is simply the face value over divide by 1 plus B10, which is the semi-annual coupon rate, brackets, okay, to the power B6, which is the number of payments. This will give you the present value of the face value amount. Now, you don't need to memorize these formulas. They are already in Excel. Just punch them in and Excel is going to do the calculations for you. So, using the old system, I calculated the present values of the coupon incomes for the 10-year period plus the present value of the 4 million. It was giving me a bond price of 2,262,000, which is close to what the cost value of the government bond for December 2023 was. Now, when you are talking about government bonds, you also need to understand that government bonds can be sold on the secondary market. On the secondary market, there are prices that are attached to these government bond investments. Just as we go to any market, you expect to find the price of an item or commodity that you are looking for. The same applies with government bonds. We expect to find the cost, the value or the cost value of a certain investment clearly on this secondary market. Now, how are these prices determined for government bonds? How do we determine the value of a bond on the secondary market? A number of factors come into play, and one of them is comparable investment. So a similar kind of investment, how much is it fetching at in terms of the interest rate? How much am I expected to make from a similar kind of investment? Assuming I want to make a decision between spending money by investing in government bonds or spending money by lending it to a bank or a corporate, how do I know which one is going to give me a better return? Obviously, it is the interest rates that will be offered to me by this investment that I want to make to the corporate, or if I want to lend it to the government, how much will the government be able to pay me in terms of interest rates? Our interest rates are normally determined by the Bank of Zambia through the MPR, which is the monetary policy rate, which is like the best rate that is used for interbank lending. So that is the rate that is normally used to determine our interest rate. Sometimes the MPR goes up, sometimes it goes down. Recently, we've seen the interest rates, particularly the monetary policy lending rate, going up and up and up. This has resulted in an increase even in the borrowing or interest rates for loans. And so the question really is, how do I know what interest rate I should offer the government of Zambia? That's a very good question. And you need to really ask yourself, if I was to invest this money in a comparable investment, what kind of return am I expected to make? Let's just look at the banks themselves. And this is something that has got me thinking, because normally financial institutions are the ones that buy huge quantities of government bonds. And when we look at how they do their trading, banks normally lend to us based on fluctuating or floating interest rate basis. Government bonds are offered at fixed rates. The interest rates or the coupon rate that you're expected to get, once it's fixed, it does not change for the duration of your investment in this bond. If you are getting a 13% coupon rate, we expect that 13% to continue for the entire 10-year period. Whereas when the banks lend money to you and I, they normally lend it to us at a floating rate, meaning that whenever the Bank of Zambia's interest rates are revised upwards, automatically the banks also revise the interest rates on the loans upwards, which is why oftentimes they will ask you to either extend the tenure of your loan or to ensure you increase the amounts in terms of your repayments for these loans. So the question that I've been asking myself is, because the financial institutions are the ones that buy huge quantities of government bonds, what kind of rates are they going to be offering the Bank of Zambia when it comes to them buying government bonds? Because previously the advantage really was, I can buy a government bond at a discount. So I'm getting an interest income. That's one. That's great. The other benefit is, in addition to the interest income, I'm also getting coupon incomes. So to a certain extent, it was very advantageous for you to buy the government bonds. Now, with this new revision, the question is, what comparable investment, what kind of returns are made from comparable investments? So let's go back to the market rate. If I was to go to the market today and say, I would like to lend you 4 million kwachas, at what interest rate can I offer you this 4 million kwacha? Or can I give you this 4 million kwacha? Just look at the bank. So when I was looking at the market rate, I was really trying to look at our current financial institution and how, the rates at which they lend money to us. And if you look at the interest rates currently on the market, you cannot get a loan at less than 25%. So it ranges between 25 to, let's say, 30%. I don't know if it even goes way above 30%. It might. So depending on the risk and the tenure of the loan, the interest rate is fixed at a certain percentage. For long-term loans, we expect them in Zambia at least to range between 25% to about 30%, but it's definitely above 25%. And so as I was doing this calculation, my question was, let's assume that the market rate is 25%. And when I looked at the results for last year, looking at the yield rate, I discovered that the yield rate was 25.5%, which gave me some kind of indicator to say probably this is the direction. And so if we assume that the market rate is 25% for a 10-year loan, we can then calculate the present value or the value of this investment in the bond. A face value, for you to buy a face value amount of 4 million, you only needed to have 2,260,000 in your bank account. And in 10 years' time, you're going to get 4 million Zambian kwachas. The difference was going to be your interest income. Meanwhile, every 6 months, you're going to be getting about 260,000 kwacha before deduction of the withholding tax and handling fee. That seems really good. With a new change in the issuance method, it means that for you to get the face value of 4 million in 10 years' time, you will need an equivalent amount in your bank account, which is 4 million. That simply means that you are buying the government bond at face value. So in order for you to buy the face value amount of 4 million, you will need to have the exact amount, because that's exactly the amount that Bank of Zambia is going to deduct from your bank account. What kind of coupon income are you going to be able to make? Remember, I spoke about the market rate and the yield rate, and also the fact that all this has to go through an auction process. So we are not really sure. It depends on the highest yield rate that wins the bid during the auction. That is the yield rate that will determine the coupon rate that we are all going to be getting for each particular tenure of bond investment. So let's assume that for January 2024, the yield rate that wins the auction is giving us a coupon rate of 25%. Because let's just clear this something else as well. We expect that coupon rates are going to be higher than under the previous issuance method, because there will be no point. It will be pointless for us to invest in government bonds if the coupon rates won't be higher. So we expect that the coupon rates will be higher and they will be matching the market rate. What is the market rate? It depends on similar kinds of investments on the market, like the loans that financial institutions lend. That could be an indicator. Possibly, if we have a well-managed government bond market where we can actually see the value of each bond, that would be brilliant. So at the moment, we are going with that. And assuming that it's 25%, we expect you to get coupon payments every 6 months of about 500,000 kwacha before withholding tax and the handling fee. Okay, that already indicates a higher coupon income compared to the old method. So what is this showing us? Coupon incomes are going to be much more than under the previous issuance method. This is because we expect the coupon rate to be higher under this new method compared to the old method, without which it will be pointless for us to invest in the government bonds. Assuming that the coupon rate for January for a 10-year bond is 25%, we expect the coupon, the biannual coupon payment for a 4 million investment in a 10-year government bond to be about 500,000. That is the coupon payment. The face value remains the same, because in the primary market, the Bank of Zambia will be issuing government bonds at par value of face value. So this face value is exactly, this bond price or bond value is exactly the same as the face value. Now, this is the end of the primary market. You've already bought your bond and it's now, it's running, it's settled. All you are now expecting are your coupon incomes and the face value 10 years from now. Let's assume that 4 years, 3 years down the line, you want your money back. What happens? You go to the secondary market. On the secondary market, you can buy the bonds either at a discount or at par value or at a premium. It all depends on the performance of the economy and the interest rates prevailing at that particular time. So let's go back to this. Let's assume that you bought this bond at 25%, right? 25%, and its bond coupon rates are fixed for the tenure of the bond, so it's 25% through and through. Now let's assume that 3 years later, so this is 3 years later. 3 years later, this bond is fetching at a market rate of 20%. The interest rates have come down. They're now 20%. What happens to, first let me do this, good. So it's now 20%. What happens to the bond price? What happens to the bond price? So if interest rates go down, the bond price goes up. Okay? If interest rates go down, the bond price goes up. So the person that is going to buy your bond is going to buy this bond at a premium. At a premium. Because the bond price is now worth more than 4 million. It's now worth 4,851,000 using the formulas that I showed you earlier, the present value of the annuity and the present value of the face value amount. So in 3 years' time, assuming that the interest rates, market interest rates have gone down to 20%, it means that your bond is worth a lot on the market. It's valuable. This is because your bond is paying coupon rates of 25%. That is more than the market interest rate of 20%. Therefore, the bond price is worth much more. So it's worth 4,800,000. So when you sell your bond, you are going to make an interest income because you are going to sell this bond at a premium. Let's assume instead of the market rate being 25%, market rates are now 30%. What does this mean? It means that your bond, which is at 25%, has lost its value. This is because new bonds are going to be issued at around 30% because we expect the bonds to be following the trend on the market. Unless otherwise, this is what we expect to see. So if the Bank of Zambia, the investors have offered interest rates, and because of the prevailing market, the market rate is 30%, and we expect the Bank of Zambia to also offer a similar kind of rate on the coupon rate, it means that your current coupon rate or coupon income based at 25% is worth less than the current coupons that will be issued at 30%. And therefore, your bond would need to be sold at a discount, which is 3,374,000 instead of the face value that you bought your bond at, which is 4 million. So you will need to sell your bond at a discount if you really need the cash. This trend can go on and on. So what is the lesson here? The lesson here is that when you buy your bond on the primary market, you're buying it at par value. As long as you keep the bond until maturity, you will get the exact par value or face value amount at maturity. But assuming that you want to sell your bond on the secondary market, now you need to consider at least 3 prices. You can either sell your bond at a discount, depending on the prevailing market rate. At a discount, meaning that maybe the prevailing market rate is higher than the value of your coupon rate. It means that for you to sell the bond, you have to sell it at a lesser price. That is at a discount. If the prevailing market rate is exactly the same as your coupon rate, you can sell the bond at par value as well. If the prevailing market rate is lower than your coupon rate, it means you can sell your bond at a premium and therefore make an interest income on your bond. So this is the effect of this new issuance method on your bond. as long as you intend to sell your investment in the government bond on the secondary market. If you intend to keep your investment in the government bond with the Bank of Zambia, you should not be worried about the effect of the changes in interest rates, because government bonds are bought at a fixed interest rate or coupon rate, and we expect you to get the same amount of coupon rate until the bond matures, and the face value won't be affected as long as, and your bond value or price won't be affected as long as you keep or you hold on to this bond until maturity with the primary issuer, which is the Bank of Zambia. So this is what I thought I should share. Basically, it is understanding the coupon rate that we expect to win the auction. We definitely expect it to be a higher coupon rate compared to the coupon rates that were offered under the previous issuance method. This is because under the previous issuance methods, we had the interest income as well as the coupon incomes. Now the interest income falls off because government bonds will be bought at par value or face value. With regards to the current bonds, the ones that you bought under the old issuance method, you shouldn't really be worried. They will continue giving you the interest incomes upon maturity. The coupon rates will remain fixed as it is, and we expect them to run up to the end of maturity under the old issuance method, unless your bond is callable. It's 7-year, it's 10-year, it's 15-year. The government might decide to call back the bond and reissue it under the new issuance method. So watch out for those callable bonds. So if you've invested in a 7-year, 10-year, 15-year bond, it served 60% of its life, you need to look at that critically. It might be recalled depending on the current market position. And what about the return? What about the yield? It all really depends. For me, I feel like I would love to get higher coupon incomes. If really, and we're going to see from the January government bond, if really we're going to be getting coupon incomes as high as 25%, that's a good thing, because you can get your coupon income and reinvest it in other ventures or in other vehicles, investment vehicles that we're going to be talking about also on this YouTube channel as well. So what other vehicles can we invest in to ensure that we're making higher returns? One thing you need to know is that investing in government bonds is just one type of portfolio. You need to have a diversified investment portfolio. So don't just put all your eggs in these government bonds, consider other investments as well. And there are quite a number that we're going to be discussing. All right. And so if you've got anything to share, I might have left out some important information. I really value your contribution as well. Consider leaving a comment in the comment section below. Otherwise, thank you so much for watching today's video. If you've subscribed to my channel already, a million thank yous to you for subscribing to my channel. If you haven't subscribed, consider subscribing to my channel by clicking the subscribe button. It is at the top, it is up here. Click subscribe right now. Thank you so much for watching, and see you next time.